Well, welcome to our High Rock monthly video for June. I'm Scott Tomlinson, and with me on the call is Paul Tepsich, our founder and managing partner of High Rock. And we're going to talk a little bit first about what happened in May. I will just anecdotally say that I had a wonderful time visiting Vancouver and our clients and their families when I was out there in the early part of May. It was actually quite beautiful. And so I've got a little photo there of Vancouver in May for all of you who haven't been out there for the cherry blossom season. It's quite spectacular. All right, let's talk a little bit about the markets in May. It was volatile to begin with, but the volatility kind of came to, as we got into the Canadian and US long weekends, the volatility came down. So markets were a little bit more stable. We saw preferred shares outperform everything else in the month. Bonds were a little bit better performers than equities. Gold and silver and Canadian REITs were the worst performers. So, Paul, I don't know if you have any comments here, but it seems just a little bit more of that market, financial market deterioration, pretty much, and we'll talk about this maybe more in a second, but on the back of not only higher interest rate expectations, but the outlook for inflation and the general economy.
Yeah, and as you said, Scott, in the previous slide, that U.S. equities in particular really would have been a lot worse if the month ended May 15th or so, because they were probably down 10 or 11%. So there was a pretty good rally going into the last week or two of May. Yeah, and I think just 30,000-foot view, if you look at what's gone on in the world over the last while, we've had the Fed and other central banks, quite frankly, since 2008, being a tailwind with monetary stimulus. Then we've had a pandemic, first time in 100 years, and now we've got inflation for the first time in about 40 years. So it really has been a lot to contend with for the markets, and that uncertainty typically drives prices lower than higher.
Yeah, and just as a measure for people who do check their portfolios, one of the benchmarks that we follow to compare our portfolios is the Ishares Core Balanced ETF. Down year to date, total return, so that includes interest and dividends, 10%. And I think if you look at your portfolio, all of our clients, for the most part, are going to be comfortably inside that minus 10% on the year. So again, there's something to be said about the way we've managed our portfolios, Paul, and I think it has a lot to do with the fact that we've got a more tactical approach. Any comments?
Well, yeah, we can talk about that when we go through the models, but yeah, tactical approach, and also holding cash, which otherwise would have gone into our global equity model, which would have been lower. So,
absolutely. Okay, and just as we always do, reminding everybody that while we talk about what's been going on in the short term, we are really focused on the long term and basically determining your goals individually as families, and then working our best to get you to those goals over time. But of course, we get into situations where there is lots of economic and political uncertainty, and that will create volatility in markets. And we want to make sure that we're helping to protect and preserve your capital as best we can, so that when we do get the ability to grow it, we're ready to go. And we do anticipate, as we've talked about before, that there will be somewhat lesser growth over the next 10 years as they're comparatively to the last 10 years. And that's also something that we have to focus on. As far as the global equity strategy, Paul touched on this, but let's look at what's gone on with regards to the monetary base or the money supply, and how the Federal Reserve in the United States and the Bank of Canada, for that matter, created quantitative easing to combat the market downturn back in the financial crisis of 2008, 2009. They had three quantitative easing cycles, and then they tightened again. They took that money out of the system back in 2015, and that was difficult, or late 2014, sorry, and that made for a difficult year for 2015 from a financial markets perspective, because there was less money. But then we had certainly had the COVID crisis pandemic in 2020. The Federal Reserve and all central banks did an unlimited amount of quantitative easing, which added significant amounts of money into the system. And as a result, that money was chasing asset prices higher and created a bubble. And now we're in a phase of quantitative tightening. So we're starting to see that money supply slowly be withdrawn from the system. And of course, there is less money, and people who need money need to sell assets. And as those assets get sold, that bubble is in the process of bursting. So there is some potentially greater downside to financial markets as we go through this process. There is also some uncertainties for the economy, but we're long-term focused, and therefore we know we'll get through this. And but we are prepared to manage our client portfolios through this particular period of time and into the future. Any comments, Paul?
No, I really don't have any comments other than to add that I still maintain that there's such a massive wealth effect in a lot of these assets. We've seen hyper asset price inflation that's gone nuclear over the past 2 years with COVID and all the stimulus, both monetary and fiscal. And quite frankly, I think the Fed, at some point in September, and their one or two Fed governors have even said so, that they may look at a pause in rate hikes in September and just see what happens with inflation. So I kind of think by September we may see the Fed pull back a little bit, maybe even they might even have more chatter about not hiking rates as aggressively as they have. But until then, markets are coming into the summertime, they could be less liquid and more illiquid. That could continue to drive prices a little bit lower here. Although I was listening to one strategist, Scott, that now he is a strategist, but he was actually looking for a summer rally, and quite frankly, that could happen too. But our position would be that we could continue to see further weakness and into September. I think the Fed may pull back a snick, and that would be good for asset prices at that point in time. That's it.
Well, you did bring up the inflation factor, and certainly at this juncture, we're still seeing inflation at levels that we haven't seen in for a significantly long time. And the Bank of Canada really has only begun its process of tightening. The repercussions of that, and we're already starting to see that happening. I think we had this conversation earlier, but you're starting to see retail inventories are growing significantly, and as consumers are pulling back on their purchases. So that in and of itself could slow the economy, and in the way the cycle works, bring that inflationary pressure back down. But for the moment, that inflationary pressure is part of the psychology now in the economic environment, and I think that's a difficult thing for consumers to deal with it, and as is always the case, have difficulty looking forward and seeing that inflation coming back down again. You want to talk about our tactical model a little bit?
Yeah. I will preface any comments I make by, please keep in mind that you have to look at the percentage of your overall portfolio that is in the tactical model. So those with a higher weight in the tactical model will notice that they have slightly better relative performance year to date or over the course of the month of May in itself. And quite frankly, that is because of a couple of positions that we have in the tactical model that have performed quite well. And number one is our largest position, which is Latex Energy. It's an oil producer. You've heard me mention it before. It continues, as everybody knows, if you own a car. Oil continues to climb. We're sitting just under 120 bucks a barrel WTI right now. This is spectacular news for a company like Baytex. They just paid out for cash the last $200 million of a 2024 bond. They have a 2027 bond outstanding in US dollars. Quite frankly, I think that bond will be all but gone in a year. I think a lot of these companies, oil stays above 100 bucks a barrel. These companies could very easily, if they stay public, they'll be dividend payers because they will be net debt free, or they may even go private. These stocks, on a valuation perspective, are still about as cheap as they've ever been, given if you look at them on sort of an enterprise value to EBITDA or cash flow basis, and that's a typical measurement of valuation, they're still quite cheap. Now, the caveat there, of course, is that oil is a commodity and it is extremely volatile. But I think the general dynamics of OPEC arguably running up against production limitations, and quite frankly, every company in Canada that I follow, which is quite a few, are really not increasing production at all. They have found religion and have been paying down debt, like Baytex. They're not. The increasing production is, quite frankly, nominal or de minimis to their operations. It's really all at the margin. They're really focused on paying down debt and then distributing that excess cash to shareholders. And quite frankly, that is because they've been burned too many times by other government action or the volatility of the commodity. So I think the dynamics couldn't be better for the oil space right now. And quite frankly, gas is an even better story than oil. We don't fill up our cars with natural gas, but we do heat our houses and cool our houses in the summertime. And we do own some natural gas bonds. We've got other positions that are oil field service companies that appreciate with the price of oil and gas on a slightly less direct basis. And then, of course, we own Enbridge and TRAP, which also are more of an indirect exposure to the energy space. So all that being said, all those positions have helped part of our overall performance. And as I said, those with more of a tactical weight will have slightly better performance than those with less of a tactical weight.
And that brings up an important point too. Clients who want to have these conversations about how their portfolio strategy is allocated are always welcome to contact us and have a discussion around the various allocation to the models and how that affects their risk profile, and if there is room for more risk, or if we should be taking risk off the table. We always want to be having these conversations because it's very fluid. It's a very ongoing process. It is all about trying to make sure that we're working towards your end goals. And sometimes this is an important conversation that we need to have. So again, we're always available for these conversations, and we want to encourage everybody to get in touch with us to have these conversations if you feel like you would like to.
Yeah, for sure. And, with that, the caveat that be careful, again, Scott, we don't want our existing clients chasing performance, which is often a common mistake of retail investors. But we do want you to have the right amount of risk to meet your goals long into the future. We don't want you to take more risks than you need to.
Yes, and that's why these are conversations, right? That's why we
Yep.
want to have these conversations to make sure that everybody is current on what their strategy is and what perhaps it should be.
Fixed income. As we saw in one of the first slides, obviously preferred shares did well. The kind of preferred shares we own typically go up in price when bond yields go up in price. Or pardon me, bond yields go up in yield and lower in price. So they act inversely or inversely correlated. So they did well. Government bonds, investment grade, and high yield all detracted from performance. We didn't really do any significant trades. We tried to add some preferred share. We are looking at, as of this morning or yesterday, adding an investment grade bond that, quite frankly, I think has about 1 point of downside and potentially 7 or 8 points of upside. So I think that's very good risk-adjusted returns. It's an interesting position that we could put on, probably one that you would never get through an investment advisor. So part of the benefit of High Rock being a fixed income, having that fixed income capability. So that's one thing we're looking at, Scott.
Excellent. Okay. Well, again, as I say, wealth forecasts and goals updates are always important conversations. So we want to make sure that we're having those. If you feel like you're overdue and we haven't been in contact to set up an appointment, please get in touch with us. I know Diane sends out emails on a regular basis trying to schedule appointments. So keep an eye out for those as well. It is regulatory requirement for us to at least update your review, your wealth forecast, and any documentation that might be overdue being updated. So all of these things are really important, and we want you to please respond if Diane does get in touch to try to get some of this paperwork in order. All right, that's it for us for today. Thank you very much for taking the time to tune in, and we will be back in a month's time to give you our next update at the beginning of July. Until then, hope you're enjoying the beginning of summer, and we will continue to keep an eye on markets and your portfolios as we head into the summertime.